front loading was done, in the previous policies. But however, in the end, it looks like that RBI had taken a prudent step, but by doing a 25 basis point rate cut in this policy. To me, today's policy was more of the science of policy making, not the science of policy making, but the art of policy making, because there were mixed economic signals available. We have with us Mr. Bhupesh Bhameta. Bhupesh needs little introduction. He's our resident economist and fund manager. He has been giving us his views on the monetary policy every time. So I'll hand it over to Bhupesh to give us on the lowdown of what the governor spoke about today. In the meanwhile, as you listen to him, as you take in what he's saying, I'll request you to put your questions on the question answer box, which we will take up at the end of his discussion one by one. So over to you, Bhupesh.
Yeah, thanks, Anirban, and welcome everyone to this post-policy call. So basically, when we entered this, so mostly, over the last 2-3 years, very rarely we get a policy wherein markets are just split down the middle about whether it's going to be a cut or a no cut. This time it was the case. Most opinion polls that you had, in Bloomberg, CNBC, in newspapers, it was like 50-50 in terms of market participants' view whether there will be a rate cut or not this time. Now, the reason for this, market's divergent view was twofold. One was that while most market participants believe that inflation was actually quite low at close to 0%, RBI's target is between 2 to 6%. The worry in the market was that because growth numbers have been quite strong, last 2 quarter growth has been 8% levels, and that was one worry, that growth is very strong. And second worry was that currency is under pressure, whether RBI will be cutting rate when currency under pressure. That was the other side's view regarding whether there will be a rate cut or not. Our view has been, it has been communicated by in multiple channels, that we had expected a 25 basis point rate cut in this policy, along with OMOs to infuse liquidity to the system. Our reasoning has been that RBI is an inflation targeting central bank, and as an inflation targeting central bank, if you start ignoring inflation being too low, the credibility of inflation targeting framework gets diluted, because your target is 4% inflation. So suppose inflation was at 8% currently, which is like 2% above the target, everybody would have been just focusing on inflation, whatever was the growth. Similarly, if it's on the other side of the symmetry, if it's close to 0%, it did warrant RBI's monetary policy response to make market certain that their inflation target of 4% is symmetrical and it is their main focus. In terms of growth numbers, our view had been that the very high, optically high real GDP growth came on the back of very low deflator. So what happens actually in the past also, the same phenomena has played out, is that whenever there's a sharp decline in inflation, in all such instances, the real GDP growth rate starts looking very strong, because while intuitively people believe that the nominal GDP growth is calculated in terms of real GDP growth plus inflation, the way we estimate our GDP is that we, for most of the segments of GDP, we first estimate a nominal growth, and from that nominal growth we reduce the inflation, and thus we get the real GDP growth. So if you look into the nominal GDP growth picture, it has been steadily coming down in the last 15 years. The average nominal GDP growth, quarterly GDP growth, has been around 11%, while in the last quarter, the nominal GDP growth was as low as 8.7, so significantly lower than the last 15 year of average. While the real GDP growth looked very good, was because from 8.7%, you remove the inflation part of deflator of 0.5, you land into a very high real GDP growth. So in the past also, whenever we had a sharp decline in inflation, every time you start seeing real GDP growth numbers very strong. If anybody has any query on this this concern, we can discuss it in the question answer segment. But our view has been that the underlying growth pressures, growth impulses are not as strong as the 8.2% growth suggests, and most likely going ahead, these numbers are going to normalize. We are going to get lower growth. And RBI today also, they came out with their growth and inflation forecast. And if you look here in their growth forecast, they are saying that next 2 quarters the growth will decline from 8.2 to 7 to 6.5%. And governor has been saying that we should aspire for a growth close to 8%. Therefore, with this declining growth and the fact that inflation is running at 0.5%, 0.6% these 2 quarters, it did merit a very a monetary policy response, which came in the form of a 25 basis point rate cut. While there was debate in the market about whether there's a need for rate cut or not, our view was that it is because inflation targeting framework means that inflation is too low, there will be a rate cut. There was no debate in the market about the need of an OMO. So market did believe that even those segment of the market which were thinking that there will not be a rate cut, even they believe that liquidity is going to get tighter, and therefore OMO is coming. Whether it will be announced today or a few weeks down the line, that was the only debate. And RBI, went in the front foot today, and they also announced a 1 lakh crore rupee of OMO to be done this month itself, in two tranches of 50,000 crore rupee each. On top of that, they also announced a 3-year buy-sell FX swap, which will further infuse close to 45,000 crore rupee of liquidity. So net 1.45 lakh crore rupee liquidity will be infused into the system in December itself. It's a pretty strong response by RBI for easing rates across the system. In terms of their assessment of growth, they believe that while the current growth is strong going ahead, growth numbers will moderate. That's point number one. Point number two, they were quite they have been some statement in the past also, and today also the statements were that because of our tariff talk which are going on with many countries, because of trade talks which are going on, there is a downside risk to growth going ahead, and some leading indicators are suggesting that growth impulses are weakening. So they were also aware that this growth number is likely going to weaken. On the inflation front, they remain quite benign, like us and like most of the market. Inflation impulses are actually quite low. So let's to give an example. Previous quarter and this quarter, inflation is expected to average around 0.5%. Now, of the 0.5% inflation, 0.5% alone is the impact of gold. And gold is something, because gold is a part of our inflation basket. Therefore, whenever gold prices go up or down, it does have an impact on our inflation. But as we'll all realize, that gold is something which shouldn't be part of the monetary policy, because it's an international commodity. And therefore, whatever happens to gold is not a reflection of the underlying inflationary pressure in the economy. And therefore, if you just ideally, we should be subtracting gold inflation from this overall inflation. And if you remove gold from the inflation, actual inflation comes down to 0%, both this quarter and the previous quarter. I know few readings last month reading would have been negative, only if you remove gold from the system, from the RBI, from the inflation numbers. So underlying inflation pressure has been like as low as it has ever been. And if you don't respond to such low inflation pressure even now, then it puts the whole monetary policy into question, the credibility of monetary policy into question. If you're targeting inflation at 4%, how come you're not responding to such a low inflation? Okay, in terms of inflation outlook also, RBI believe that inflation is benign. We believe the same thing. So there are multiple factors, which are playing out in terms of inflation. One, previous year and this year, the monsoon has been exceptionally good. And typically, whenever monsoon is good, it reflects into food prices for the next 12 months. So while previous year's monsoon was very good, therefore we had low food inflation for the last 12 months. This year's monsoon has again been quite good, which means that for the next 12 months also, there's a good chance that food inflation will remain quite low. That's point number one. Point number two, crude prices have been very low at 65, and with Trump sitting in US and ensuring that the crude prices remain low, all the reason why we'll see low crude prices going ahead. Thirdly, and more importantly, China has been a major disinflationary force across the world for the last 12 months, because they have not been able to export as much to US. Therefore, they have pushed up their export to other non-US economies. So Chinese prices have fallen across the world in terms of their export prices. So that's also been a strong disinflationary force to the global inflation. So that's not only impacting India, but if you look into the inflation in East Asian economies also, and other economies where China is a dominant player, you see that inflation has been quite low and is expected to remain low for foreseeable future. So all the three factors, low core inflation, low crude price, low food inflation, mean that food inflation is likely to overall inflation is likely to remain quite low. One worry for the market was that because INR is seeing a lot of pressure, so therefore that may be the reason why RBI may not cut rate. But RBI has again, on this topic also, RBI has been repeatedly had mentioned this point that the monetary policy is determined by what happens in the domestic economy, what happens in the growth, inflation in the domestic economy, and they don't look and they typically separate out the impact of currency from monetary policy. Currency is taken care of by its FX management system and framework, and MPC basically looks into the growth inflation framework. The only way the currency impacts RBI's monetary policy is via the spillover of weaker currency on inflation growth. That is the only way it could have impacted. And RBI, in its judgment, believe that the impact is not that material, and in any case, inflation is so low that even if there is some offset because of currency, that should not be material. So going ahead, we believe that because of our view that growth is likely to moderate from the current high levels, and also inflation is likely to remain low, we see further space for rate cut by RBI in one of the next two policies. So maybe next policy or the policy after next, there's a good chance that we shall see another rate cut. Uh, Going ahead, while a lot of people will believe that this is the end of the current easing cycle, uh, while it's uh, we're not really sure that that may be the end of the easing cycle. We see there's a decent chance, that we may see further rate cut from there after that also. But as of now, we are over the next 12 months, we next six months at least, we think that we'll see another 25 basis point rate cut. In terms of impact on market, no, we believe that despite the cut in policy rates, bond yields have been still has remained elevated because the term premium has been quite high. But we believe that when the market gets sense that RBI has been quite dovish, is likely to remain dovish, it will gradually flow into the term premium also and reduce the term premium as well. As you can see, in this cycle, besides the rate cut which has happened of 125 basis point, we've also seen a decent amount of CRR cut, closer to 1% of NDTL. It has come down to 3%. And going ahead also, we see that there is a space for, besides this 1 lakh rupees OMO, we think that over the next, between Jan to March, there's a good chance that we'll see a further, at least 1 lakh rupee of further OMO from RBI. And for the next 12 to 15 months, I think there's a good chance that we can see OMOs to the tune of around more than 4 lakh crore rupees. So there's a big space for open market purchases of government security by RBI for the next 12 to 15 months. Yeah, that is going to be a very positive driver for bond yields going ahead. And the reason why we are saying that we have a space for such a high OMO going ahead is because if you just look into the RBI's forward book, RBI is currently in the data as of October. RBI's current forward short book is at around 60, closer to $60 billion, and that number may have increased over the next 1.5 months because we have data till October also. And if you just multiply $60 billion with the current currency rate, that means that there will be a drain of closer to 4 lakh crore rupees. In fact, 5 lakh crore rupees of drain in liquidity will happen purely because of this when this forward matures. And on top of that, we have currency leakage also, which typically happens every year. And also, as the bank's balance sheet grows, typically that also requires more currency. So I think our sense is that over the next 12 to 15 months, besides this 1 lakh rupees of OMO, we can see closer to 4 lakh rupees of OMO over the next 12 to 15 months, which we know with such a huge demand coming from RBI, our sense is that the current bond yields are quite currently, quite steep, and there is a case for further decline in bond yields from the current level. Not only in the 10-year segment, which is currently trading at close to 6.5. In the 10-year segment, we believe that yields will likely come down to, so if we assume that there's only one rate cut, okay, even if there's no further rate cut, just because of these OMOs, we expect yields to come down to 6.25% or close to 6.2%. And if there is another rate cut as we expect over the next 6 months, then there's a good chance that the 10-year point can come down to as low as 6%. Now, this gives a decent possibility of capital gains for bond investors in the Indian fixed income market. Uh, the spread in between 10 to 30, 10 40, I mean 30 and 40-year point are even wider, and there's a further, you can if things play out as we believe, then there's a further space, the bigger space of capital gains in that segment of the market, 30-year and 40-year point. As you can see, liquidity has been surplus by RBI, and RBI has hinted that they will want to create to enable liquidity to remain in surplus. So we expect that they will target 2 to 1% of NDTL surplus in the system, and these OMOs are a part of that, and further OMOs will be coming as we go ahead. Now, just to have a look at the macro backdrop currently, how things are in the economy right now. If you look at high frequency indicators, as we mentioned, that it's a mixed picture, and things are not as strong as one would see if the economy was growing at 8%. If you see the past real GDP growth of 8% plus, typically most high frequency indicators are generally much more stronger than they are currently. Especially if you look into these IIP indicators, coal, cement, exports, M3 growth, credit growth, electricity growth, which has been negative in few quarters, a few months. Petrol growth, most indicators suggest that the underlying growth momentum is much softer than what you would expect from a 8% plus real GDP growth. PMI is one indicator which has been quite strong, but even that has begun to decelerate somewhat. To be fair, government is doing a lot of things to push for growth, which we believe is going to be growth positive. But it will be, it will take some time for that to play out in the economy. They have come out with income tax relief. They have come out with cash transfer scheme, which many state governments are doing. On top of that, they've had GST rationalization, and on top of that, we had repo rate cut. So total, stimulus of 1.6% GDP is already, in the system. That is going to support growth. So don't get us wrong. We're not saying that we are saying it a slowdown, big slowdown. Only thing we are saying is that 8.2% number is perhaps giving a sense that growth is too strong. If you remove the impact of deflator in the economy, the growth impulse would have been somewhere around 6.5 to 7%. It's a decent growth, but I would say much lower than what we have been aspiring for. And I think these government measures are going to help in pushing up growth going ahead. If you just look at the high frequency indicators, domestic, because monsoon has been quite good. So rural India is doing decent. The two-wheeler sale number, tractor volume numbers, they have been quite good, which is typically a good indicator of rural demand. If you look into the FMCG rural demand also, that is running much higher than the urban demand. So the rural India is actually doing somewhat good. Urban indicators have been somewhat lower. If you look into the PV sales, despite this the rate cut in GST, there has been some pickup recently. But if you look at the broader trend, the trend has been weaker. The corporate salary growth has been on the weaker side. There has been some a lot of you'd have seen media articles also about the impact of AI in terms of hiring, IT hiring. We're not sure that it is AI or not, but we are seeing that the hiring from the IT industry has been somewhat lower, and that is having an impact of on this that is maybe contributing to this salary and wages growth, which has been on the lower side. Uh, but that for India, if you look at the cross country picture, Indian growth still remains quite high. Uh, One worry which has been there both for the government and also I would say they would have also been thinking this is that despite this lot of the tax cut which government has done and I would say some pickup in the economy, the corporate capex has been quite low, and while it is picking up, but if you just look into the earlier trends, the corporate capex growth has still been somewhat on the lower side. And what these rate cuts do is that they by reducing the cost of capital, by reducing the NPV of a project, the threshold level of NPV for a project, they also nudge industries to go for more capex, and I think that would happen over the course of the year. On the other hand, IIP, if you look into these numbers, they have been running quite low. That is one segment which has been under pressure.
Bhupesh,
Yeah.
sorry to interrupt. Your slides are not moving ahead. So
Not
maybe
moving. Okay. Still not moving.
no.
Just
I think you can probably, now it is moving. Yes.
okay. Just give me a moment. It's better.
Yeah, it's better.
Okay, okay, okay. So yeah, yeah. So IP growth has been, as you just mentioned, has been running quite low. Uh, if we also look into the key problem, I would say the one main pressure point which the economy has been facing has been that India's external account has come under pressure. I think if you ask me the risks which the economy is facing currently, I would say that the biggest risk that we face is in terms of India's external sector, and that also because of what is happening in the India has been subjected to a high tariff from US, and US has been India's largest trading partner. So that is having largest export destination. Sorry, so that is having a spillover effect into India's external account. As you can see, India's trade deficit last month has come at very record high of $41 billion, and you can see the past 10-year trend. This has been a very steep decline in trade deficit. While services exports have been quite good, but because merchandise trade deficit, where US is our biggest export destination, that has coming under pressure. That is one key worry that we are seeing, and that is spilling over to India's currency. So uh, while INR has come under pressure, and the reason I would say almost entirely rests on what's happening on India's trade account. And our sense is that as and when this trade deal gets done, or at least the penalty 25% tariff which is there in India because of purchase of Russian oil, once that gets over, I think there will be a positive impact of that on the currency. So if you just look into INR versus the EM basket, it is sharply lower. If you look into INR versus the Asian FX, also it is sharply lower. So most indicators of INR suggest that INR has been since April when these tariffs got announced, and I have been one of the worst performing currencies globally. However, if you had those who are attending this call in the past, also we have mentioned that earlier on our NR was one of the best performing currency, but now that has changed to this, and simply because of this very high tariff. Another thing, in the beginning, I mentioned that why we are quite positive on inflation, and one reason which I mentioned was that the Chinese export, which is happening, to major economies, so that the price of Chinese exports have been falling substantially. That is one very positive spillover impact on inflation globally. So since US imposed this tariff on China, and even after COVID itself, while Chinese exports globally started going up significantly, this is the Chinese exports, their prices have been collapsing. So that is one another positive spillover impact of that on India's inflation. You can just look again here how Chinese exports have been zooming over the last globally. That's one thing which is problematic. While let's show here very interesting chart. So India's trade relationship with US and with China are like mirror images. So while in India's trade deficit with China is very high, India's trade surplus with US is quite decent. So what is happening is that in a trade surplus partner where we are exporting close to $86 billion last year, that has come under pressure, and that is spilling over to India's trade deficit, in India's balance of payment, and that is spilling over to India's currency. That is one worrying factor which is there, which is problematic for the economy. Otherwise, most indicators suggest that while growth is not as high as this 8.2% number suggests, but it is chugging along quite well. So, and with RBI's, with so much uh, consumption boost which the government is giving, there's a good chance that economy will gradually be picking up pace. In terms of credit growth, that has been which was falling for quite some time, that has begun to pick up from less than 10% now to 11.3%. But deposit growth has still been quite weak. Banks have clearly not been able to garner as much deposits as they should have been garnering given the high credit growth. That has been one pressure point, and that is one reason why bank deposit rates haven't fallen as much as they could have otherwise, given this 100 basis point of rate cut which is already paid out, and a further 25 basis point rate cut which is going to happen, which is happened today. Uh, uh, if you just look in the transmission in lending rates and deposit rates, transmission is playing out. But if you just look here, this is the weighted average deposit rate of banks, and they've hardly moved. Haven't moved much, because banks have not been able to cut deposit rate as much as they would have wanted, because the deposit growth itself is has been quite weak. One positive thing, which I would always point out to fixed income investors, and at the current juncture, is that the real rate of the economy is very high. So whenever you invest in a fixed income, the anchor should be what is the real rate you are getting, and whether the return that you are getting, whether it compensates for inflation or not. And at current juncture, the real rate in the economy, because inflation is quite low, the return which you're getting from fixed income assets, they are more than compensating for the inflation, and therefore it's quite a opportune time for investment into fixed income assets, simply because the real rates are quite high, which means that the compensation for putting money into fixed income assets, you're getting a decent compensation out of it. And on the other hand, RBI also mentioned today also that with real rates too high, it's a problem for investment also, and this also creates space for further monetary easing by the central bank going ahead. And if you so they are basically, if you ask me, what should a rate in an economy be, why we are so so why are we so strong in terms of that rates will go down? So there are two anchors of rates. One is what is the rate with respect to the inflation, what we call as real rate. And if you look here, the real rates, as we have already discussed, are quite high, which calls for further monetary easing or further reduction in rates. The other anchor for rates are that what is the rate currently with respect to the nominal growth. So ideally, the gap between the rates should be as much lower compared to the nominal growth, because only then you are going to incentivize investors to invest into the risk assets. So all investment are entails some risk in equity investment, of course, but all investment on the ground, FDI, all the KPIs which corporates do, they all entail some risk in taking that investment. And there has to be and whenever a typical corporate does an investment, he would always benchmark that the expected return from the investment with what is the nominal rate currently in the economy. Okay, so if I have to invest, I'll check whether the return which I'm getting from the project, how does it compare with the nominal rate which I'll be getting in a fixed income asset. And if you find that the return that you're getting in a fixed income asset is higher than what you think will be the return of the economy of your investment, you will be somewhat disincentivized to invest. If the rates are closer, you would want the rates, you'd want the return from investment to be decently higher, comfortably higher compared to the return that you're getting in a fixed income asset class. Therefore, ideally, rates should be much lower than the nominal growth. And what we are seeing here is that, or in other words, nominal growth shouldn't be much higher compared to the should be much higher compared to the rates. But what we are seeing is that the gap between the nominal 10-year and the 10-year nominal GDP and 10-year, that have been substantially falling. And if we assume that nominal GDP is the expected return that you can get from an investment class, and 10-year is GSEC is the return that you'll get from a fixed income asset class, which means that the delta you are getting in undertaking more investment is not sufficiently high compared to the 10-year point. Therefore, the incentive to invest comes down. Therefore, whenever a central bank is looking at the policy in terms of rates in the economy, they should be looking at what are the current rates with respect to the GDP growth. And what we are seeing currently is that the difference between the nominal 10-year point and the nominal GDP and the 10-year GSEC has come down significantly, which again means that 10-year GSEC yields should ideally fall further from the current levels. So whether you look into in terms of spread from the repo, or you look at the real rate, or you look at the spread between the nominal GDP and 10-year point, all suggest that the rates currently are quite elevated compared to where the state of the economy is, and therefore rates should be falling. And what has happened is that because the corporate bond deals and the GSH yield hasn't yet fallen substantially, therefore the issuance which is happening from the corporate. So while bank rates have fallen, banks lending rate, as we discussed earlier, bank lending rates have declined. So corporates are getting a better deal, relatively better deal in investing in taking loan from the banks vis-a-vis from the corporate bond market. Uh, uh, and therefore, the issuance which happens in corporate bond market, that growth has come down to only 2%. So while earlier we saw that the credit growth is going up, a big reason why that may be happening is that the issuances in the corporate bond market has come down. So that may be the reason why the corporates or other borrowers are shifting somewhat from the corporate bond market at the margin from the corporate bond market to the banks. And then just come to inflation, the reason why all this easing is taking place. If you look here, inflation has come down to almost 0%. And even core inflation, which is inflation if you remove gold, impact of gold, it also come down to 2.6%. So this is the no. If you look at the last so many years, this is the lowest reading that we have seen in inflation. And food inflation, that is at negative -3%. So all if you look here, this chart you have the better indication. So both, if you look here, food inflation is now coming up to negative territory, and core inflation. This uptake is basically because of the impact of gold. If you remove gold, this even comes down to around 3%. So core inflation at close to 3%, food inflation at negative levels. All conditions set for a easier rates than they are currently. One worry which has been there, which we have been mentioning in the past calls also, has been that FDI outflow has been quite strong, because a lot of it is because investment which was done earlier is being cashed out because of IPO market, or because the Ps may be getting good return from investment done earlier. So that is also putting a pressure on India's external account. That remains a worry. So there are two sources of some concern in your external account. One is that the trade deal because of this tariff, very high tariff in India. India's exports to US is likely to get impacted, and secondly, because of this very high FDI outflow, that will also creating some pressure on India's external account. On the positive side, however, the services inflows have been quite strong. India's services export that has remained quite strong. That is the one positive thing which has happened. FII inflows, they have been quite flattish, while equity, this is the 1 month rolling, this is the 12 months. In 12 months, equity has been on the negative side, but debt flows has been quite positive. Going ahead, there's a good chance that because we also been upgraded, and also because JP Morgan has already inducted India into its bond index. There's a good chance that Bloomberg may also include India into their bond index, which will result in further inflows coming to India's bond market next year. One worry which had been there for the bond investors had been that because there was a lot of issuances happening in the long yield curve, 30-year point, 40-year point, 50-year point. There, the spread has the yield over there has gone up significantly. Now, our government it has reduced its issuances in the long yield curve, and it appears that from the RBI, what RBI said that going ahead also the supply they are cognizant of this high yield spread, and they will likely take steps to ensure that the supply from which comes from the government in the long yield curve is such that the borrowing cost over there comes down. So some part of that has already happened. I think if yields doesn't come down, then in the next calendar, this is going to have a further impact on the longer, on the 10-year, on the 30-year plus supply. But in any case, with the current spread that you are getting, close to 80 basis point, the spread themselves are quite lucrative, and I think a lot of buffer is already placed there, in terms of spread which is there. So they remain an attractive, point in the yield curve. As I just mentioned, the spread between a 30-year point and 10-year point does remain very elevated at this juncture, and our expectation is that this spread is likely to come down going ahead. And even today, we had a decent rally in that point, and I think going ahead also, as overall rates come down, I think inflation, insurance will also get some more inflows. Also because supply will automatically get adjusted going ahead if these spreads remain quite high. and these rates are quite elevated. The spread is quite elevated, and therefore our expectation is that they will normalize going ahead. And these are high duration yields, bonds. Therefore, the duration gain which you can get, if what we are saying is plays out, is going to be decent. In terms of corporate bond market, the spread are broadly at median levels. Our sense is that, with liquidity being given, a lot of liquidity being given now and going ahead also, and as market gains more confidence on RBI's dovishness, we shall see further decline in corporate bond yields, especially in the shorter end, the 3-year point, 5-year point, 2-year point. So less than 5-year point, and particularly the 2-year, 3-year point, and of course less than 1-year point, will be seeing decline in the spreads. So in terms of investment recommendation, I think, as we just mentioned, fixed income asset class remains quite attractive. The return that you are getting, the real return that you are getting is remains quite healthy, one of the highest in a very long time. And a lot of earlier rate cut has not yet played out in the fixed income asset. Therefore, there's a good chance that yields will soften from the current level. Even the long end yields haven't yet, the earlier rate cut has not yet been priced that much in the longer end of the yield curve, and they should start getting priced in going ahead, which should result in a decent gains for investors who are placed in that segment. In terms of recommendation for funds, I think people should gradually move up based on their investment. We always suggest that you should invest in funds based on your risk and investment horizon. Based on that, always just ensure that try to move slightly upward in terms of your investment horizon, because we see that a lot of juice is still there in yields, especially in corporate bond yields. So investors, who are looking for 3 to 6 month, our banking PSU, sorry, our money manager fund, our floater fund provides a very good place to put your money. People who are investing in liquid, they can start looking into ultra short term category, where I think returns can be decent. A money manager fund also for people who are not investing, who doesn't have a very long investment horizon, can look into our money manager fund also. People who have close to 1 year investment horizon, I think a corporate bond fund, our banking PSU fund, a short term fund, they are very attractive investment opportunity. Even our GSEC fund, where the duration we are running a pretty high duration over there. Our income fund also provides a good opportunity for people who are investing, who have an investment horizon of more than a year, and who can also so because the duration over there is a little higher, so there will be some volatility in those higher duration funds. But I think the risk reward at the current juncture, even in higher duration funds, if you are okay with some volatility and you have a closer to 1 year investment horizon, that remains quite favorable. So I'll pause here, and if we have any question, we can discuss them.
Thank you, Bhupesh, for such nice insights into what the governor discussed today morning. Participants, audience, I urge you to post questions in the Q&A box. And while you do that, I'll probably shoot a question to Bhupesh to begin with. Uh, the growth, basically, and as you began with. So I hear around that there has been a lot of talk about higher growth, but that's the real growth number, and nobody is speaking about the nominal growth. And you have always mentioned in your previous calls also that we should see the growth from the lens of both nominal and real.
Yes.
Now, I believe that in this juncture, the rural demand was holding up the growth factor. But now that, with good monsoon happening, probably the rural earnings will see some stress, and government spending will also become lower, at this juncture, because they have front loaded the spending, I believe. In that case, except rate cut, will India have any other, kind of tools available to them to stir growth? I mean, if it is coming down from their decadal, lower highs, like above 10, you always said that it has been an average.
Yeah, yeah, it's a nice question. I agree with you. So if you look into what are the key drags that we are facing in terms of growth, I think the biggest drag that we are facing, we mentioned here, is the trade deal which is pending with US. They are our biggest exporting destination, so that is putting a lot of drag on India's growth. Uh, uh, that is one key factor which has to be sorted out. Uh, Secondly, if you see over the last 12 months, government has taken a lot of steps. Both government and RBI has taken a lot of steps to boost growth. We have seen a GST cut recently. Earlier, we had seen an income tax cut. States are announcing with every election. States are also announcing a lot of these cash transfer schemes, which are quite positive for consumption, and we are already seeing the impact in terms of rural demand. Uh, and monsoon has been good for the second consecutive year, which is also quite positive for growth. The what is lacking here is that one, this trade deal, okay, which is not, of course, not entirely in our hand. The second thing is that the corporate investment has not picked up to the extent which is required in the economy, and for that segment to pick up, rates should remain quite low. So what we are saying is that monetary policy has to do a heavy lifting here. Government has, on the fiscal side, government has already done maximum that it can do. And if we assume that they are sticking to the fiscal consolidation roadmap, which we think they are. So fiscal deficit can't go up further. On the fiscal side, you've given massive cuts in, earlier you gave a cut in corporate tax 5 years ago. Then you have given cut in income tax, a big cut in income tax. Then you gave a cut in indirect tax also. So government has been doing a lot of things to push growth, uh, especially to boost consumption. But now private corporate capex has to pick up. Until the time that happens, it is essential that monetary policy also gives a helping hand to growth, and that is exactly what they are doing. And they have to give helping hand in two ways. One is through the policy in terms of rate and liquidity, which we all know they are doing. And secondly, in terms of regulatory easing, and that also they are already doing. So they are up to the task, but these things take time to flow on the ground. And till we have these external uncertainty in terms of the trade deal, and also globally things are not looking very very good in terms of US growth impulses, China growth impulses. So they are a drag in the economy. So net, I think monetary policy will have to do a lot of heavy lifting. They are doing it. They are up to the task. And let's hope that with policy being so easy, we'll have corporate capex cycle also.
Got it. So the next question will be on inflation. I think the inflation has been undershooting RBI's expectations, and that has been continuously.
Yeah.
So, do you think RBI is being overtly cautious? And on the back of it, I'll also ask you to Nuansky, why holding this stance as neutral when all the directional, announcements are being, on the other side? Why keep that flexibility available to them, on both sides?
So again, very nice questions. So why keep the stance as neutral? I would say there are actually a lot of uncertainty globally. So one is what will happen on the tariff front. Every 15 days you get some news from the global front, from US, particularly from President Trump over there. Now this is happening, now this is happening. There are so many moving parts, with China, with US, and these are our biggest trading partners, and our biggest import source of import and our biggest source of export. Both are having this global, at least a trade conflict. Um, and that will have ramifications on India. In US also, so many things are happening. For example, now over the next 1 month, US Supreme Court is going to announce whether these tariffs are valid or not. So suppose they say they are invalid, then you be assured that there will be a lot of volatility in the market, because now everything will get turned up. Abhi kya hoga? Then President Trump will come out with something new to respond to people. So, every few days, something new is happening. So with so much uncertainty, with the global trade front, on the currency front, and all these things have a spillover effect on India's growth, India's investment, and also India's inflation. So why pre-commit ki you are going to ease or not ease? Neutral stance give you a ability to do both ways. So just preserve that optionality and remain cautious. And then when you get space, you keep on cutting. I think that is an apt way which RBI is working, and that's fine. We are quite happy with that. Yeah.
Got it. Got it. So just a continuing question, like if the price pressures remain, like inflation is low, basically, will it have
Yeah.
any bearing, kind of a negative effect on the economy? Like, do you see that like is going ahead? Like, or as of
So
moment it's
yeah, so ideally speaking, if we have real deflation for a prolonged period of time, it
uh,
does have a negative impact on corporate profitability and does have a negative impact on investment. And therefore, we are saying that RBI should maintain the centrality and the symmetry of 4% inflation target, and I think they're up to it.
got it.
So if be very sure that if they get a whip that inflation will remain so low for a longer time, then they will come up with even more cuts. And that is our base case. So while we're not giving that long a forecast, we saying that there will be one more 25 basis point rate cut. But if you ask me 2 years down the line where rates will be, my base case, while it, with in such uncertain world, many things can happen. But if you ask me, I think there's a more than 50% probability that 2 years down the line, rates will be decently lower from even the current even the 5% level, because our sense is that inflationary pressure in the economy are going to remain low, and therefore they will be. And if they remain low, and in the situation in the eventuality what you are mentioning, I think there will be more rate cuts to ensure that inflation get back to 4% level.
Got it. Okay, we have received a few questions on the currency. Of
Okay.
course, it is reaching 90. I mean, so we have received a question from Mr. Paul Joseph that we are seeing devaluation of the rupee. Wanted to understand how the rupee will be affected due to the rate cut. Is it bad for the balance of payments of India because we are major importers? In fact, I would also add to it and ask the weakening of the rupee, does it have any bearing on the FDI flows? And how long can then, if it affects, then how long can RBI stand in the sidelines, just witnessing it, without doing something?
Yeah. So ideally, for FDI, okay, if you are a foreign investor and you are investing in a country, you would want that country's currency should be to be stable, because your returns are in dollar or in the foreign currency. And if you are investing at 90 level, maybe if you have invested at 80 level and now currency is at 90, you already lost 10% in your investment. So always all foreign investors want your currency to be either stable or even better appreciating. Now let's remove the appreciating part, but they will want the currency to depreciate as less as possible. And therefore, I agree with you that if rupee continues to slide down, it does have a negative impact on foreign investment. And our sense is that given how high rates are in India currently, if rupee was more stable, debt flows into India would have been much higher. Okay. Now, having said that, not everything can be done to please foreign investors, and if economic theory says that if the pressure is happening in an external account, then the best way to sort out that pressure is through the adjustment of currency. So if the BOP is turning negative because of higher trade deficit, because of lower export from export to US, it is a portion that market forces should allow currency to depreciate. That's exactly what RBI is doing. So what RBI is doing is that it is letting rupee depreciate gradually. Now, okay, now there's one thing that whether rupee should depreciate or not, I think given the balance of payment pressure, it is okay for the currency to depreciate. But whether it should depreciate fast or not, now, whenever there's a sharp depreciation in currency, it does have an impact not only on the FDI, FI flows, it also has impact on the balance sheet of many corporates who have borrowed abroad. So while gradual adjustment of currency is good for the economy, very sharp movement of currency is actually not that good for the economy. And therefore, what
Mm,
RBI does is that it allows currency to depreciate gradually.
got it.
This year, with all this noise around rupee, it has depreciated by only 5%. 5% depreciation is, I would say, a little bit higher than what it used to be. Average depreciation had been around 3%, 3.5%, but still it's 5%. So it's not like heaven has broken. So it's still
Okay.
a manageable depreciation. And with such a big shock, when your biggest exporting partner has imposed 50% tariff, I think it's a okay outcome to have. uh, our sense is that, so if in all fundamental parameters, if you value rupee, so how do you value rupee? You value rupee in terms of where inflation is. So if your inflation is running low, your currency should appreciate, but it is depreciating, which means that rupee has become quite undervalued. If you compare rupee with other EM economies, if you compare rupee with your India's inflation, in most of these matrices, rupee has become very weak. And typically, these weaknesses and these strengths, they tend to mean revert. So our sense is that as and when this trade deal gets settled, we will see a reversal in rupee, and rupee can see a decent appreciation from these levels. But so long as this trade deal doesn't get settled, pressure will remain on the currency, and it is up to RBI to manage this pressure. Now, whether they have the wherewithal, they definitely have the wherewithal. So even today, RBI mentioned that their reserve is at $686 billion. I repeat, $686 billion. And even the worst estimate of BOP deficit in India would be maybe $40 billion. Okay, and so $40 billion BOP deficit and $680 billion reserve, which means that if you are funding the entire deficit by selling dollar, you have a sufficient kitty to manage for the next many years. Even
Got
today,
it.
with this all these negativity because of this trade 50% almost embargo level of tariff, if RBI wants, it can fix rupee at the current level. But they want, I think, by their action, it seems that they want market forces to determine where the currency should be. They are obviously intervening to soften the flows and to ensure that there's a manageable depreciation, and that's what is happening. So, from a purely macroeconomic angle, I would hazard that this depreciation in rupee is maybe okay, maybe even welcome, because that's how the trade balances get adjusted.
Got it. Thanks for that nuanced answer. We have received a question from Mr. Mohan Krishnan. Differential rates between India and US and even Japan is narrowing. Will it not make FIIs move away from Indian bond market, basically?
So basically, so why? So first, we should ask this question: ki why there should be any differential rate between India and US? The reason why you have a differential rate is because of what people believe as whether a particular country is following a decent monetary policy, different decent macroeconomic policy or not. Now, what is happening is that since the COVID crisis, what we have seen is that I would say not COVID. I think in the last 10 years since India adopted the inflation targeting framework, it has pursued a very conservative macroeconomic policy. We have been very steadfast in keeping inflation well anchored, and we have been very steadfast in keeping a deficit level very manageable. For example, I'll give you example. So, for India's deficit this year, the central deficit is going to be closer to 4.5% GDP. The US deficit is running at 6.5% of GDP, and that despite US running almost a super hot economy. So they have come out with a big inflation scare in the last 2 3 years, but still they're running a very high, fiscally I would say imprudent policy. And on top of that, going ahead also, it's quite likely that the deficit level will remain quite high even when the growth is very strong. So what I'm saying is that since the last 10 years, not only India, but even I would say the entire most of the EM economies, they are pursuing a more DM-like macroeconomic policies, and these DM economies like Japan, US, and Europe, they are pursuing more EM-like policies. And if there's a convergence in policy, it's quite obvious that there should be convergence in rates also. For those who are interested in this year's World Economic Outlook, IMF had come out with a full chapter 2 of the World Economic Outlook is on this topic itself, that how has EM become so resilient. And they mentioned that the resilience is because our policies have become much more conservative, much more orthodox, and that is having an impact on India EM's resilience. Our currency is much more stable than in the last, if people who remember the taper tantrum and what happened in the GFC, and compare that with what happened in the COVID crisis, we have become exceptionally stable currency. So our policy has become much more stable, much more orthodox, much more conservative, and markets are rewarding that in terms of lower yields and also a stable currency. So when we say why a stable currency, but if you look, I again repeat, our biggest exporting partner has imposed a 50% tariff on India. That's the highest tariff on any other economy. If this was the case 10 years ago, when our policy was not as conservative, there would have been a significant pressure on the currency. Compared to that, 5% depreciation, I would take it. Yeah.
Got it. So now a little bit about the transmission of rate cuts. So I think backed by easy liquidity, there was a fair amount of transmission in the first half of the year.
Yeah.
I wouldn't know if you agree, because the governor said that at the back of 100 basis points of rate cut, there were weighted average lending rates came down by 69 basis. Would you say that that is an okay transmission? And if that is okay, what is making the RBI, kind of infuse durable liquidity? And always they are saying that this will aid transmission and all, despite the CRR cuts and all of that. And despite announcing a couple of measures today, some of the market participants are of the view that in the remaining part of the financial year, we'll probably need much more OMOs, some more OMOs for the liquidity to sustain.
Yeah. So transmission has been, all over the place. What I mean to say is that if you look into the bank credit growth, if you look into bank lending rate, bank deposit rate, their transmission has happened decently. So there, if you look into weighted average lending rate, they have fallen. Deposit rates have also fallen. So while and the reason why banks got this transmission much better is also because banks are now a significant part of bank lending happens via these which is benchmarked to the external lending rate. So if the repo falls, many of you people's housing loans will be benchmarked to repo. So their housing price will EMI will automatically drop. So a lot of bank lending now happens because of this benchmark to the external lending rate. So they there the transmission has become much more swifter, and there it has played out. But if you ask me in terms of the bond market, their transmission is still pending, and particularly in the long end GSEC, even I would say medium end GSEC, and in the corporate bond space also. So there, the transmission is still pending, and a lot of transmission over there is still has to play out. And I think that that will gradually proceed as and when, because now markets are getting more confidence that policy will remain dovish for a prolonged period of time, and therefore, why invest in a lower end thing and try to arbitrage the higher return that you get at the higher end of the yield curve. So I think this transmission is ongoing in the bond market, and that should go ahead. And that should happen, I would say.
Got it. Got it. Okay. So, how would you weigh the market reaction to today's policy? Like, are you happy with it? Did the market welcome the policy, or what do you think? How did the yields move? And how would, on the back of it, how would the bond investor? I'm sure you told already. How would
Yeah.
the bond investors position themselves? Should they shoot for capital gains at this juncture, or should they just, kind of invest based on their time horizon?
So I would, as I just mentioned, okay, today's reaction was pretty okay. So besides the RBI policy, there was also an auction, 10-year government option that also has an impact on this technicality. So I think yields fell across the curve, and I think that the reaction was positive. The longer end fell much more than the shorter end in terms of the actual price also, and also yield also in the longer end fell significantly. Of course, in the less than 1 year segment, always you will have much more transmission in the rate. So across the yield curve, there has been a decline in bond yields. And for investors, I would again reiterate that the spread that you are getting in the 10-year paper versus repo, the 30-year, 40 paper, these spreads are quite attractive. The only thing is that these are longer duration papers, so there will be volatility. So if anybody has a 1 year time horizon, I think the risk reward in the long end of the yield curve remains quite attractive, and people who are okay with some volatility and have a 1 year time horizon, I think these are attractive entry points to put money on. People who have a shorter time horizon and who don't want that much volatility, I think 2 year, 3 year corporate bond, that segment, gives a lot of juice is still there in that segment. So a corporate bond fund, a banking PSU fund, a short-term fund, all these category, for investors who are okay with some volatility and are here for 6 months type time. I think these are very attractive investment opportunity.
Great. Okay. So the last question probably, I mean, so with regards to the Fed funds rate, actually, so in October, I think they came up with the first 25 basis rate cut, and and the market participants were expecting another 50 basis on the horizon. So if that turns out that way, or in whichever direction, will that have any bearing on the Indian monetary
Yeah,
policy,
surely,
or?
surely. So yeah, so it will definitely have an impact. And I just didn't mention this. Sorry for that. But another positive factor that is there for Indian bond yield is that Fed is likely to ease further. U.S. bond yields are likely to ease further from the current levels. U.S. Employment data is softening pretty decently, and therefore I think that is also going to be a tailwind for Indian bond investors. US dollar is the reserve currency. US is the the mother market for financial assets. And therefore, whenever US bond yields fall, it has an impact on yields across the world. In fact, those who are academically more oriented, they can see that there's a few research paper also which says that for many economies, the impact of the Fed on their asset class is sometimes even more than what's happened in their own central bank. So if Fed does something, it has even more impact than their own central bank on their asset classes. So I don't think it's the same for India, but that's the same. That's one thing I'm saying for the most of the global economy. And therefore, if because Fed is also likely to ease, we agree with the market assessment of one rate cut in December, and at least two next year. It could be more over there if economy softens further, and that should also be a positive for India's fixed income investors.
Great. Okay, that brings us to the end of today's call. Thank you, Bhupesh, for explaining us in so much details. Probably the key takeaways for us will be that there is more space for rate cut at this juncture. Unlike some market participants saying that there might be a long pause. I mean, you are gunning for more rate cuts. Monetary policy being the only tool left now, probably to stir growth. We'll also await a speedy conclusion of, we hope, a speedy conclusion of the trade talks, which will bring us, to a certainty with regards to the bond markets and everything. Till that time, thank you, audience, for joining, and goodbye. Uh, till the next time, monetary policy call.
Thank you.
Thank you.